I watched a $300 million rocket ship implode almost overnight. This was by far my best investment. 4 rounds of funding with other famous investors. A real startup with real revenue and traction.
Welcome to Facebook.
And then it crashed. What looked like a unicorn turned out to be a house of cards. This is the real story of my worst investment ever, not in theory, somewhere where I've lost a lot of money. This isn't just about one failed deal. It's about how fragile even the best startups can be and why investors don't want to talk about what kills them. In this video, I'll tell you what made this startup look like an amazing success, what risked investors missed, including myself, how a single failed wire triggered everything, and the question that I ask founders now to avoid repeating that mistake. But before we start, this is a brand new channel, so if you're not yet subscribed, please consider subscribing to see my newest video every week about behind the scenes of the YC ecosystem and the VC world overall. Thank you in advance. Even the best founders can get wiped out. And the worst part, we didn't even see it coming. So this YC startup was a neobank. It was an award-winning product. The insight that the founders got was not to rely on third-party integrations to build his own stack, but to build everything in-house. The result was an amazing, sleek experience for the customer because he controlled everything from A to Z, and so customers just loved it and they flock en masse. At peak, they had more than 1 million accounts opened. They not only had real growing revenue, they raised multiple subsequent rounds of capital with super impressive, renowned investors. And so I invested as well. And because the company was growing like crazy, its valuation was growing as well. And so we invested, and 6 months later, the valuation had already doubled. And then a year later, the valuation tripled again, only to double one more time only a few months later. And so we started somewhere around $20 million valuation, and we ended up at over $350 million in valuation. In my mind, it was gonna be a unicorn only a few months later, right? You keep the trend going. When you're at 350, only a 3x from there makes you a unicorn, and that's really what I thought. This was a deal I was so proud of that I would brag about it all the time. It was my poster child of one of the best investments I've ever made, and then overnight it disappeared. So what happened? Well, that fast growth had a cost. They were spending like crazy and they were burning a lot of money. Now you have to remember, today this might seem obviously a bad idea, but in 2021, 2022, this was what everyone was doing, and this was what we were expecting from them. The game at the time was growth at all cost. So yes, you're burning a lot of money, but if you're growing very quickly as well, it doesn't matter. You're gonna raise more and more and more. And that's why this company was raising so many rounds so close to one another. And to be honest, I didn't see anything wrong with that because again, this was the game at the time, and achieving such growth is extremely hard. It doesn't matter if you're burning some money. And at that point, they secured their next funding round of $25 million. And the deal was signed, but the money never came. What happened was the fund manager called capital from its LPs, but the LPs had just been wiped out in the stock market in tech, and they didn't want to or couldn't send the money to the fund, and so the fund couldn't send the money to the startup. The problem was the coffers were empty. This startup had dozens and dozens of employees, a big partnership with a big bank to allow its accounts to function, and that was costing a lot of money every month. Without the 25 million hitting the bank account, the situation started to look very dire, and the company was on the brink of insolvency and actually closing its doors. When it became inevitable that this would happen, a very last minute, last resort sharky investor came in, offered to save the company, but decided to dilute everyone 95%. So all of the money that I had invested was diluted 95% down to 5% of its original value through several mechanisms, including a pay-to-play round. The deal we were offered was to reinvest at that point to save a little bit of equity in the company, or not put any more money and be completely wiped out.
What happened to all that money?
So rather unwillingly, we reinvested a little bit in that round, but still the majority of our prior investments were diluted a lot. Then the CEO left. That's a bad signal. Then they pivoted and they tried again, and they never achieved any reasonable traction. The company's still alive today, but in my mind, it's already a write-off, and I don't think they're going anywhere. I want you to learn from my mistake, and I'm gonna share with you now questions that I ask founders and the mindset that I want to put them in when I invest in them. The main question is, what happens if tomorrow your next investment, your next check, your next funding round doesn't come? Can you put the spending at zero and still survive? And if you're not able to answer that question, if you're saying, well, if I don't get the next 2, 5, 10 million, my company literally dies, that's a big problem for me. It's very risky to build your entire business with the risk of completely having to shut down if you miss a deadline or a payment, an income payment coming to you. What smart founders have to do is be able to even fire everyone if you have to, but keep the company afloat with zero spending until you recover and you get to better days. And again, that's not necessarily easy or what we want them to do in general. That's why they raise money. It's to spend that money in order to grow faster. That's the whole crazy thing about this startup, is that it was not necessarily doing anything wrong per se, except not managing its finances and putting itself in a risky situation where it could die. Another question you can ask founders before investing is, what happens if you don't sign any new contracts in the next 90 days? Do you still have enough money to keep spending the same way that you're spending today? You can ask them about their customer pipeline or funnel. And of course, one of my favorite, how do you acquire customers while you sleep? What's your automated go-to-market and customer acquisition system? You can ask them about lead time to conversion. How long does it take you from getting to know a customer for the first time to actually signing them, onboarding them, and getting the money? All those things will help you paint a clearer picture of the actual flux of money inside, outside the company, and the risk it runs if it's out of cash. So this is my personal experience, but it's sadly not uncommon at all. We've seen this movie before. I can give you the example of Fast that was sort of applying the same playbook, spending a lot, growing quickly, crashed and burned, went to zero entirely. Another example I can give you is Quibi, who spent $1 billion building a Netflix competitor for phones without any user retention. Same thing, does not exist anymore. One last example is Zoom, a robotic pizza maker with a SoftBank-like burn, and again, crashed and burned. And by the way, don't think those are terrible entrepreneurs. All of those founders were very, very strong, talented people, and they had a lot of hype that didn't prevent them from disappearing and closing. Gary Tan said it best: there's a moment where founders need to stop playing and start coaching. If they don't level up, the company dies. And so the pattern here is as follows: startup that raise too much and burn a lot in pursuit of growth at all costs, but don't factor in any margin for error. This is when bad things happen. So what did we learn today? Well, great numbers aren't enough. Amazing founders and amazing growth is not always enough. Anti-fragility is what matters. If your company grows for 2 years and then dies, there's no point. You want to build or invest in a startup that's going to win for the long term. That's how the results compound, and that's how you actually have a great outcome. If you're a founder, build for resiliency and have a margin for error. Don't bet everything on a single customer or a single wire from a single fund. If you're an investor, dig deeper. Ask the tough questions and help the founders realize if they're in such a position. Losing money is part of the job, but not learning from the mistakes, that's a real problem. So now I want to hear from you. Have you invested in a company that sadly went to zero? Drop your story in the comments. I want to learn from you as well. Thank you so much for watching. Please subscribe to the channel if you haven't already, and I'll see you in the next one.